Kenya has just upped its central bank rate to 150 basis points to 18% from 16.5%. We're now joined by Dr. Jim McFie, Director of Strathmore University, in our studios in Nairobi for a reaction. Jim, thanks so much for your time. Most people had said prudence would be to hike, but sensitivity would be to keep it unchanged because consumers and business are under pressure. How do you feel about this decision?
Well, I feel it's very important that the rate is, first of all, maintained, as you say. I think the central bank has a very good reason to raise the rates further. When you think there's about $1.5 billion hot money flowing into Kenya and out of Kenya all the time. So when the rates go up, obviously you're going to get a very good return here in Kenya.
Yeah.
The 2-year bond, the Treasury bond, is now yielding 22.64%. It's a phenomenal rate of interest. Now, as you mentioned, the downside, of course, is people who are borrowing. I was talking to a young lady today who her mortgage repayments have actually doubled in the last couple of months.
Yeah.
So it's a very, very difficult thing for people who are borrowing. I've just had a meeting. I'm the chairman of Sasini. We fortunately have no borrowing onshore. We've got about $1 million offshore loan. The rate of interest there is 5%, so we're not affected. So those companies which have got a lot of money have no problem whatsoever. And what we're doing is we're now investing any surplus cash that we have in 2-year bonds. The 91-day Treasury bill rate is over 16%.
Yeah.
So, but I think the most important thing is the rate goes up, and what will happen is this hot money comes in. And that means that the exchange rate is going to go more favorably in the way for investors and also for importers. And this is really the thing that is creating inflation at the moment.
Yeah.
The high oil price exacerbated by the high rate at which you have to buy the dollar. That's the real problem there.
Okay, obviously, let's talk about the one aspect of this decision, the positive side, what you're talking about, what the impact it's going to have on debt and income securities. We are seeing now almost parity between the inflation rate at 19.7% and the interest rates at 18%. And henceforth, this is what you're talking about attractiveness of government securities. It's important because we are dealing with a government that is on a major infrastructure drive, and they will need some of this hot money to subsidize their own plans. So there is a silver lining to the economy. But is it enough for them to just try to get foreign exchange or the exchange rate stability and those kinds of issues sorted out?
Well, I think one thing is that if loans are more expensive, this is going to cut down on the people who are actually borrowing to import. So one of our biggest problems right at the moment is that we have a huge trade deficit. It's about $8 billion a year. And this is because of the fact that there is major infrastructure going in. The housing market in Kenya is absolutely booming at the moment, and it's still booming. But with interest rates going up to what it is now, that's going to slow right down. In fact, we had a situation similar to this in the mid-90s where the housing market, some people feel that we are in a bubble at the moment, and the housing market actually did burst the bubble in the mid-90s. We could see something similar, in which case housing development is going to go down substantially. Our imports are then going to go down. And also because, for example, fuel is so costly at the moment, a lot of people are doing a lot less driving than they used to be. So I think the high interest rates will certainly make people think twice before they're going to take a loan. Mind you, we have always worked in a high interest rate environment in Kenya. And so some of the older people say, this is back to normal, you know. So people will continue to borrow even when this lady, her interest rates are now 25% on her mortgage.